Thank you for being here. This is a great honor. It's wonderful to be at a conference in which I like every paper that's presented. I really want to thank Claudia, Ray, and Dan for putting this together. I can think of very few honors that are higher than this. And as many of you know, I've had a pretty good year. University of Georgia has a named professorship, so when I was on campus, at the beginning of August, I met the very first Harold A. Black professor of business. The university on August 4th dedicated its new $50 million dormitory, and the name on it is Black Diallo Miller Hall. And we were three of the very first black freshmen to enroll at the University of Georgia in 1962. I know I don't look that old, but I don't want to bore you with the details of what went on there, but let's say that it was very interesting times. When I was a sophomore, I wrote a paper on the Federal Reserve, and I asked the professor, how do you get to be one of these guys? And he said, you either get an MBA and become a banker, and preferably own the bank. I didn't think there was a very high likelihood that that was going to happen. So I picked alternative 2, which he said was go get a PhD and get it in one of the areas in which the Fed is interested in. And I, taking money in banking, was interested in banking, but I was also interested in monetary processes and wrote a paper on that. But one of the papers that my junior year really influenced me was reading Gary Becker's Economics of Discrimination, which was published in 1957 when I was in the 7th grade. As you all know, being professors, universities are different. I think I had one multiple choice true false test, and it was in biology, botany at the University of Georgia. Everything else were problems, essays, short answers, term papers, spend all of this time in the library. Students today, of course, can't spell library, much less know where it is. But when I read Becker's Economics of Discrimination, and I cited in my paper, I was struck by the fact that he said that economics did not have the tools to analyze the causes of discrimination, only the effects of it. And I know I quizzed the professor on why is that, why is that, why is that? He really didn't give me a satisfactory answer. The second thing was, as pointed out last night, Becker, who was a huge Chicago Cubs fan, cited baseball as an example of racial discrimination because the black baseball players had significantly higher batting average than the white ones, and the pitchers had significantly lower ERAs and winning percentages. And he cited that as being an example of discrimination because if you were black and on a Major League Baseball team, you started. You were a star. When he looked at the benches of the Major League Baseball team, there were no black utility players. The benches were all white. He said that if you discriminated, it was because, and it had a pecuniary cost to you, then you got some sort of psychic income from discrimination. Well, actually, what Becker should have done is to go back and think about his own micro theory. And that is, there were 16 baseball teams in existence in 1957. There was a huge supply of baseball players. And so you had this large supply of players competing for a relatively small number of positions. So, without hurting yourself, when you picked a black player, you would pick only the very best ones. The other ones who were sort of average, you looked at them and you looked, it's like the average white band. You remember that group? And you looked at the average white bands of people, and who did you pick? All the managers are white, all the front office people are white. If you could choose between a group that looked exactly alike as far as qualifications, except for those demographic characteristics, typically we've always found that the people that make that decision, if allowed to discriminate, will pick the people that they are most comfortable with. So it was no surprise that if you have this large pool of qualified people whose abilities are just below that of the superstars, that you would only pick the white people. And so what's the remedy to that? Well, the remedy to that, of course, is to get a whole lot more baseball teams. Because if you get a whole lot more baseball teams, it dilutes the talent, correct? If you are my age or older and are a baseball fan, every single one of those people will tell you that the quality of baseball played today is worse, even though the athletes may be more athletic, than what was played back in those days. If you go to the lineup of those baseball teams, they're all Hall of Famers, the starters. And you can't say that now. All right? And so if there is more competition, then there is a greater cost to discriminating. When I went to the Control of the Currency, my mentor from the University of Georgia, Bob Dentz, asked me to come up and help him build a research unit. I was at the University of Florida, and I hated the University of Florida. And one of the reasons was that there was really no interaction between senior faculty and junior faculty. And I was writing, I had written my dissertation under the great Carl Brunner, and so I was writing these fairly technical papers in monetary theory. And I got very dissatisfied because I knew that the only people who were going to read those papers were other academics and would have literally no impact whatsoever. And so when offered an opportunity to go to Control the Currency and actually learn about banks, because I found that most banking professors, the only thing they knew about banks was that that's where they had a checking account. So when I went to the controller's office, within the first month, he let me accompany an exam team to Citicorp. They gave us a whole floor of their building in New York because the examiners were going to be there that long. It was a revealing experience. Within the first 3 months, the controller comes into my office and he says, Harold, national banks have been accused of discriminating in the lending decision against blacks. Go find out if it's true. I said, yes, sir. There are only a few problems. There's no data. Data does not exist. Okay? Mortgages are a localized lending product. There is no developed secondary market. The mortgage lending instruments are unique to the individual lender. There's no standardized instrument. There is no demographic information on the mortgage app itself. And even if you had the address of the applicant property, there was no geocoding. So what did we do? We said, okay, a priori, we said, well, we really think there's a lot of discrimination going on. And the reason we thought there was a lot of discrimination going on was because there was no competition in the mortgage market. 85% of the mortgages were originated by savings and loans who were local organizations that had no branches. The banks made relatively few mortgages, and they made them usually to their better customers as a courtesy. So what we did was we picked the 4 largest bank lenders. And by the way, the banks didn't want to lend this because since there's no developed secondary market, they would have to hold that in their portfolio. And its maturity structure was completely different from their other assets. So we found the 4 largest lenders in 4 different areas of the country, and we went and sat down with their loan officers and asked them what was important. We built a lending document with their concurrence, and the controller gave it to the national banks and said, use this as your mortgage app for this period of time, make a copy of it when it's completed, and the loan decision, send it back to us. Actually, send it to the FDIC, because they had much more experience in handling data sets than we had. You said, well, what about the demographic information? It was that we had a tear-off on it that had race, sex, marital status. And we said, the applicant was to fill this out, tear it off, put it in an envelope that we provided, and drop it in the mail. And then that goes to the FDIC, they pair them up. And why did we want them to do that? Well, if you thought you were going to be discriminated against, would you want that information on the application form? And it's of course not. All right, we got the information, and we looked at each other and said, all right, we have the data, but we can't run the regression analysis. And the reason we couldn't was because state-of-the-art was OLS, was ordinary least squares. Ordinary least squares assumes that the dependent variable is boundless, and yet we had a binary 0-1 dependent variable, and I guess in today's culture, it would have to be non-binary dependent variable in OLS. That's a joke. Okay, so we couldn't estimate the effects. Dear friend of mine who was at the FTC, who was a fellow student from Ohio State, who was an econometrician, that I met once a week for a beer at a local bar, I told him the problem, and he said, have you ever heard of probit analysis? And I said, no. He said, well, it's used in the hard sciences, and especially in engineering. I'll give you a paper. He gave me the paper, and it was Eureka. That was the method. And so we built the model, we had the data, we used probit analysis / logistic regression analysis. I saw some probit here. And we ended up being the very first paper in business and finance to use that type of analysis. The end result, we found weak statistical evidence of lending discrimination, but we also found stronger evidence of redlining, courtesy of the FHA. And we said we were going to explore that later. What came from that analysis? Well, one was I lost my job at the University of Florida because I was on progress to be promoted in tenure. I had produced one decent article a year in one decent, acceptable journal. And then I went to Washington, and my department head at Florida said, if you continue to research lending discrimination, we're not going to support you for promotion and tenure. He said, because do you really think that any top journal will publish a piece on lending discrimination? Well, they didn't think so. I did. I said, the reason why it hasn't been, I said it hasn't been published because it hasn't been done correctly. There was a series of Pulitzer Prize articles in the Atlanta Constitution on discrimination of lending in Atlanta, and they all used percentages. 75% of the black applicants were rejected, 12% of the white applicants were rejected. The blacks are being discriminated against. Pulitzer Prize. Sounds like 1619 Project to me, right? Well, that's another story. Okay. So I persisted in doing lending discrimination work. I came up for promotion and tenure and was told that one person voted for my promotion and tenure. It was fine. I wasn't going back to Gainesville anyway. I mean, yeah, I was a Georgia Bulldog. I never converted to being a Gator. So what happened? When I left the controller's office, I was recruited to come to the University of North Carolina at Chapel Hill. Much, much better department, absolutely brilliant department at that time. I could run down the names. The top producer of cited papers in the discipline was on that faculty. And we had 3 of the top 10 in all of the country. I've never been on a faculty like that in my life. It was a wonderful experience. And when I would run into my colleagues from the University of Florida at professional meetings, they said, we really screwed that one up, didn't we? Because our first 5 papers were all in A journals. The first paper was in the AER, the next paper was in the Journal of Finance, and then we hit the JFQA and the QJE, and you just go down the list. Because provide the proper data set, use it in the proper fashion, and there should be an audience receptive to that. From a practical standpoint, what did you get from it? And I admit, it's all my fault. You got CRA that came out of that because of the discrimination result. Because CRA was enacted, I think, 2 years after we started all of this research. You got HMDA coming out, and because of HMDA and the HMDA laws, you had this all of a sudden outburst spate of research because you had data. Then because of that, the Boston Fed paper, Alicia Mundell et al., was published in the AER. Now here's the interesting thing about that. That received incredible coverage because they found discrimination at the highest level of significance. And so the national press said, Federal Reserve Bank of Boston proves that banks discriminate against blacks in the making of a mortgage. There's only one problem with that. And by the way, when the Fed announced that they were going to do the study, I knew all of the Fed people, and I corresponded. I talked with the person who was over this area and who was a governor, and I said, I see you're going to do this study. Why don't you let Bob Schweitzer and me do it? Because we have all this history. And he says, no, we're going to let our economists at Boston do it. All right, so the result comes out, and a friend of mine at the FDIC gets the Fed data. He and I sit down and we break everything down, and lo and behold, they had lumped all of the lenders in the Boston MSA together. And one of the things that we made certain of when I was at the controller was that we would not mix savings and loans, savings banks, and banks in the same data set because of the structural differences they have and the ability of them to write mortgages. Banks actually were rather restricted in the type of mortgages they could make. Because savings and loan, as most of you know, were put in place just to make mortgage loans. And it took an act of Congress, which I helped write, by the way, the Monetary Control Act of 1981, to give them the powers to have a much wider and diverse portfolio. All right, So what we did was to take out the other lenders. And because look, all the lenders in Boston were getting tarred with the same brush. Sure, you may find this high degree that indicates discrimination, but does that mean that all 500 lenders are discriminating? Of course it doesn't. Well, what he found was that he could find evidence of discriminating among any of the institutions other than the banks. And so, Ken, this is the paper with you. The paper with you is on lending terms, right? Is it black on? It is this paper then. Ken is a co-author with me on the paper that resulted from all of this, which is entitled, "Do Black Banks Discriminate Against Black Customers?" Because we found that the Boston results were being driven by a black-owned bank. That if we eliminated the black-owned bank from the data set, that the discrimination that the Boston Fed found went away. Did I remember that correctly? Okay. All right, so one of the things, and I was glad that Munger pointed this out, one of the things that I've always tried to do is to be very careful about this. And one of the reasons why I look at institutional structure is because of my experience at the control of the currency, which really taught me also that I should look at things not just on a national basis, but I should look at it on a regional basis too, and if possible, if I have enough observations, on a bank-by-bank basis. So that is what I learned from that experience, and I can tell you, and you probably know, that in this area there are still authors who will commingle within their data set disparate institutions, and if they did further diagnostics, they may come out with something that's very different. Well, Janet Reno, remember her? And her Justice Department accused a major lender, a Southern bank, of being the largest discriminator that they had ever seen in the granting of mortgage loans. Well, the chief economist of that bank was a classmate of mine at Georgia. And he called me, knowing my research, and said, "Come find out if that's true. And if it is true, we will settle with them. And if it's not true, we will fight them." I came in. First off, I read the analysis done by DOJ statistician, and I said, well, even if it is true, this doesn't show it. Because he used the wrong statistical analysis. He obviously didn't know anything about banks. And he estimated his equation using what we call then a controlled deletion method. More likely, most people know that as some form of stepwise regression. And anytime a variable entered that lowered his adjusted R square, he threw it out. And so when he was confronted by me, who asked him, and my former doctoral students will know about this, I said, okay, here's your equation that you estimated. Tell me what it says in words. Remember, I told my graduate students I would do the exactly same thing, and I said, if you cannot tell me what this means in words and I understand it, it has no meaning. You don't say 3x to the 4 power minus 3x. That's what it means. No, it means something in words. So tell me what it means. He couldn't tell me. When we did our estimation procedure, we didn't find any evidence of discrimination. The Federal Reserve was holding up an application that this bank was making to acquire another bank until this was resolved. We had a meeting at the Fed. The Fed governor looked at their economist and he said, well, what's the answer? And he said, basically DOJ is full of it, Dr. Black is right. And so they approved that application and it opened up an entirely different world for me, and that world was the one of consulting. I became very, very active in being an expert in cases in which lenders were being accused of discrimination. I will give you one or two examples. One example was, what's this thing about you get punished for good deeds? Never leave a good deed unpunished. All right? And this was a case of a bank that was making short-term loans to indigenous inhabitants of an indigenous inhabitants reservation. They were making loans to Indians on the reservation. I was just trying to be politically correct. Okay, so they were making short-term loans to Indians on the reservation, and the Federal Reserve Bank in that district was suing them for making predatory loans, but they were the only lenders who would lend money on the reservations, and those were the terms. Guess why they were the terms? The only jobs that were available on the reservation were in the reservation office or the police force, and most of those people did not have a job but would get a monthly check from the casino earnings. And the regulator said, you're engaging in predatory lending. What was the end result? The end result was that the bank stopped making the loans and the Indians stopped being able to get any of these small cash short-term loans. But that was the only way they could avoid being fined. Okay? And so, of course, we would like our regulators to have and exercise better judgment than that. But I can tell you for a fact that the consumer examiners at the regulators, and I know because I oversaw them in two different places, and when I was on the boards of Home Savings of America, then the largest stock S&L in the country, and then on New Century Financial, the second largest subprime lender in the country, I oversaw compliance. I can tell you that the compliance people working in the industry are junkyard dogs. That they look for compliance violations within their own company, which is why compliance in those companies always report to the board of directors and not to the other officers, the CEO, president of the company. They report directly to the board of directors because, you know, they're almost like think of internal audit. Internal audit's the same way. Okay? All right. Well, in the federal regulatory agencies, the consumer protection people go and look like junkyard dogs for violations. It's what they do. And so, when they were all rolled into the CFPB, first of all, you say, well, why were they rolled into CFPB? They must not have been doing a good job. There is no evidence that any of those, any of the regulatory agencies were doing a poor job. There's no evidence at all. It's just that the political winds, especially Elizabeth Warren, pushed for a single agency because she said that agencies and departments could be captured by the industry. Now, we all know, if we've done that sort of research, that that is true in some cases, in which the regulated can actually capture the regulator. In the early days, there was a considerable amount of research done on the relative strength of regulators, contrasting the FDIC, the control of the currency, one where you get state charters, and the other where you get national charters. And there was found to be, in some periods of time, some banks would threaten to leave one agency and go to the other because of onerous regulations, and the regulator themselves, seeing an outflow of banks and losing influence, might consider, and some people said did actually change those regulations to be more lax. And so they said this competition between the regulators was seeking the lowest possible denominator. And so to combat that, they were to roll all of these, if you will, junkyard dogs into one big junkyard dog, the CFPB, which has been mentioned today, and I consider to be one of the 3 terrorist organizations within the federal government. When I was at Chapel Hill, I got a call from the White House and ended up being appointed to be on the very first NCUA board, National Credit Union Administration Board, just like the same political level as a governor of the Federal Reserve. And this was the first one. There were 3 of us. Previously, it had been governed by a single administrator appointed by the president, confirmed by the Senate, but could be fired by the president. So they decided to change that, put in a board with fixed terms. And it was supposed to be, like some of the boards in Washington, bipartisan. So there are 3, so the party in power is to get 2 seats and the party out of power to get 1 seat. I got a call and I ended up being nominated by Carter, confirmed by the Senate, on the first NCUA board. That was very interesting because that was a result of the Financial Institutions Act of 1978. And we all know what happened in 1979, 1980, and if you're not old enough, here's the history. It was the worst recession in US history. It didn't qualify as a depression, but there was double-digit inflation, double-digit interest rates, 3-month T-bill rate was at 18.75%. Prime rate was at 21%. If you wanted a 30-year fixed mortgage, it was at 14.5%. And we had double-digit unemployment. That's pretty bad. So I get appointed to NCUA, and one, the S&Ls are failing, and the FSLIC, the insurance agency, will go bankrupt if it tried to liquidate and pay off the accounts of the people in the S&Ls. Why? S&Ls, remember, no secondary mortgage market, basically, holding long-term, low-interest rate mortgages in their portfolio when the interest rates on their deposits were rising above that. Without any effort at all, they generated negative net worth and by law had to be shut down. Credit unions were doing the same. I'm sitting on the NCUA board and I said, we're faced with the same problem. Our insurance fund was going to go bankrupt. Credit unions were going into negative net worth. And I said at a board meeting, you know, we can easily solve this problem. And I was asked how? Connie was a credit union official at the time. She can vouch for this. I said, let's just suspend GAAP. Because GAAP was requiring the institutions to mark their portfolios to market, I said, why don't we just let them carry them at book? And lo and behold, the negative net worth became positive. We didn't have to shut them down. Now, here's the problem with that sort of strategy. It has a name. It's called forbearance. And forbearance only works if the economic circumstances that generated are short term. If they are longer term, then what did they call it? The butcher's bill? The bill that you will be presented with will be much larger than if you had taken the initial hit. We were fortunate. The recession was short enough that by the time we put them back on GAAP, our insurance fund was in fairly solid position, but after I left, they did recapitalize it. The FSLIC failed, and I was one of the 4 public interest appointees, because I had gone back to North Carolina at this time, to be on the advisory committee to merge the FSLIC into the FDIC. There were 4 of us, plus there was a representative from every Federal Home Loan Bank district. Well, the one from the West Coast was the CEO of Home Savings of America, and he knew about my discrimination work, and he said, will you come and do this at our bank because we have an FDIC exam coming? And I said, sure. And we went and did the analysis and presented it to the FDIC examiners, and they didn't even examine for compliance. Home Savings was so grateful that they asked me to join their board and oversee compliance. And the first thing I did was to fire their compliance consultants, because I said, if you get sued and I'm the expert on the other side, and if I use what they have generated, you will lose. So we got a company whose work I respected. I was on that board until we sold it to Washington Mutual. Well, during that interim period, we had terminated the CEO who brought me on board. 2 years later, he calls me. He's lead director of New Century. And he says, do you know what we do? I said, yeah, you make subprime loans. He said, we want you to come on the board. He must not have been terribly upset with me because we fired him. And I said, but you're a subprime lender, and I have this list of questions I have to ask you about your lending practices before I agree to come on your board. He said, well, come out to California and ask us. Talk to our people. They satisfied me on every single issue. I joined their board. Compliance reported to me. Since we were high profile, he said, try not to get us sued. And do you remember Acorn? They picketed one of our offices, the one in San Antonio. And I flew out to San Antonio and sat down with those people, and I said, well, what are your grievances? And they listed them, and I said, okay, fine. And I said, I'll go back, we will answer each one of these, and we will address every single one of these issues. And their pickets disappeared. And I spent so much time doing this sort of thing that they actually gave me extra compensation, and I almost gave up my day job because of all of the time I was spending with New Century. And I'm glad I didn't, because the very next year that whole market collapsed. And New Century was one of the first of the subprime lenders to go bankrupt. Here's one thing that's interesting. There is a paper out a few years ago that takes the New Century portfolio and analyzes it. We actually had 4 bidders for our portfolio because, if you will, we were one of the good guys. Our subprime mortgage was looked upon as a starter mortgage. And we would roll people over after they built their credit. The reason I went to New Century was because of one thing. in all of my experience of dealing with discrimination issues, I became fairly well versed in credit reports and credit scoring. And when you did a deep dive to find out why blacks had lower credit scores than whites, even given the same income, there was one thing that was there, actually two. Whites had higher savings rates and higher home ownership. And the main vehicle that whites used to save was to grow the equity in their home. And since the blacks had significantly lower home ownership, I think in part to the FHA, that when you looked at two groups or even two individuals, if one was black, one was white, and you'd say, well, they have the same income, they have the same job history, they have the same education. Why does the black person have a lower credit score? And the answer was they had less wealth. Now, if you have children and if you have adult children, you may have done this. I did this with both of mine. When they came up to get their first mortgage, I augmented their savings. And after they were accepted, they sent me the money back. Because that's what the lenders would do. You know, when we would ask lenders what's important, and they would say the amount of savings in the account should be equal to X number of whatever it is of their income, because it provides a cushion in case of job loss. Okay, so I said, well, how do you improve the home ownership of black folks? Well, the market invented subprime to do exactly that, even though, by the way, the majority of subprime customers, our majority of subprime customers in California, were whites. Does that surprise anybody? Do you want to know why they were white folks who had excellent credit records go borrow in the subprime market? And the answer is very simple. If they went to a bank or a savings and loan, or a mortgage broker to buy a house in the California market, which literally seems to be doubling in value overnight during that period of time, they would have to wait for a month. If they went to a subprime lender, within 3 days, they would have the money. And so what were these people doing? You don't call it, is it rolling? What is it called? When you buy a piece of property and then flip it when the market jumps. And that's what they were doing. They were buying a piece of property, and then, since the market was going up so rapidly, they would buy it, they would turn it over, they would flip it, they would buy another piece of property, and they would do exactly the same thing. Well, guess what happened when the market collapsed? The reason that we went into the recession was not because of the failure of subprime borrowers, but it was the failure of prime borrowers and many of the borrowers in the subprime market who were actually not what you would think of as subprime customers. Bob Schweitzer and I were going to write a paper on that before Bob's untimely death. But the market had addressed the issue of how do you build equity in households with low home ownership. The legislatures and the regulators killed that because they effectively, in the laws that came out of subprime, kill the subprime market in mortgages. And what was the result? We've talked about it here. The result was that while home ownership rates were narrowing between blacks and whites, after subprime, they have dramatically increased again, and legislators who hated subprime, like Elizabeth Warren, have bemoaned the fact of falling black home ownership. And yet we have some answers. We heard one here when we were talking about Dodd-Frank. And the other part of that, not just Dodd-Frank, was if you put Dodd-Frank with the elimination of subprime, then you have an answer as to why we have this problem. And how do you address it? If you go and say the only way we can address this is to bring back subprime, you have no chance at that happening because it's been so besmirched. So I went through that whole period, but during this whole period that I'm talking about, we were producing, I think, some fairly innovative papers. Do black customers get discriminated against black banks? Ray DeJaneiro and I did one of the very, very first papers analyzing whether borrowers of accepted loans face differential terms. I have a paper with Bob Schweitzer on loan terms as well at banks using a technique called canonical analysis. So we were doing, I think, some rather interesting and rather unique things. When Ray and I did this paper, we did this paper because I had a data set on yield spread premia that we call overages, at least the lender called them overages. All right, they exist on every mortgage instrument, but you don't know anything about them. Okay? They are a major form of compensation for loan officers. So if that is true, and by the way, what is it? It's the spread between what you lend the mortgage on and what the secondary market will pay you. And that spread is split 50-50 between the lender and the loan officer that originates the loan. So since the customer doesn't know anything about it, remember Munger was talking about this, you know about automobiles and that you can negotiate sometimes the price off of it, provided it isn't a one-year-old Porsche Carrera S model, which is sitting at my local Porsche dealer for $32,000 over what it listed for new. It has 1,027 miles on it. It is such a pretty car. But I sold my last Porsche when I retired from UT because it just got too expensive to maintain. But what Ray and I did was say, look, if the customer doesn't know about it, then wouldn't you expect it to be maxed out on every loan, right? It's not. And you say, well, why isn't it? And it's because there are people out there, like some of us, when they tell you, you say, well, what's the interest rate on this? And they say, it's 4.5%. And the first thing out of my mouth always is, that sounds a bit high. I'm sure you can do better than that. And when they do better than that, they are reducing the yield spread premium. And so what we found was that, sure, there were differences, but the differences were contingent upon the bargaining ability or willingness to bargain of the applicant. Isn't that true with automobiles? Look, there is this seminal piece in automobile lending by Ian Ayers, and it's an AER article, and he finds what we all know, and that is women pay more for the same type of vehicle than men, and that blacks pay more than whites. Okay? Okay. Now, how many of you in here, would know the gender thing, right? Does it surprise you to know that women pay more for automobiles than men? Does it surprise you? No, it does. Yeah. And then what we thought about mortgages, basically going into this, was that since black folks have been told all along that they were being discriminated against, if the lender somehow says yes, you go, thank you, Jesus, and where do I sign? All right, so our paper actually makes that sort of statement, but Ian Ayers found one other thing, and I'm sure this probably brings back some memory for Ken, is that he looked at the behavior of black automobile dealers and black sellers, and his statistical results were no different. You know what it told me? It told me that this wasn't a racial/gender discrimination issue. Right? I mean, if black salesmen treat their customers exactly the same as the white salesman, you have to go back and understand that in all this lending stuff, people were saying that the reason why blacks are discriminated against was because there were so few black loan officers. What I used to say is, well, where are the Asian lending officers? Because Asians had a higher rate of acceptance than whites. As a matter of fact, out of fun and games, when I was at the controller's office, we ran our regressions in which we eliminated Hispanics and blacks. And guess what we found? We found that whites were being discriminated against because Asians got much better terms than the white applicants did. And we couldn't even find any Asian loan officers in Boston and in all these other places. We'd have to go out to San Francisco. So we concluded that this is not a racial issue. And by the way, I've concluded that with what I'm writing on systemic racism for Ray and Liberty Fund as well. And that is, it's not a racial issue, it's an economic issue. It's an issue of competition. Because one of the things that we have found, and I've sort of mentioned it and other people have too, is when the federal government comes in or state governments come in to rectify a problem, they end up making it worse for a certain group of people that they may have intended to help. Now, it doesn't make that whole group worse off. As a matter of fact, some of that group will become better off because there will be more funds available to them. We've talked about that. But on average, it will make the people they're trying to help worse off. And so if I were still out there, I would doing research and had not retired, I would still be interested in looking at what motivated me in the first place. And that is, I want to look at the impact of regulation on the institution and then how it redounds to their customers. Citibank reacted to Dodd-Frank by cutting out the bottom 15% of their clientele. And the bottom 15% of their clientele were supposed to have been helped by the capping of fees for Dodd-Frank. And you also know that one of the things that came directly out of Dodd-Frank is that the bank stopped offering free checking. That just disappeared. Oh, and by the way, let me give you another up-to-date example. If you have an EV, God bless you, because this is a vanity machine. And as long as you don't get stuck in traffic or they have a hurricane, you're okay. Right? Because if you get stuck in traffic trying to flee Florida in an EV, get caught in a 24-hour traffic jam, get stuck, because your battery tank runs down. When AAA comes out, they're coming out with gas cans to fill up or at least put it in the gas tank of the cars that are internal combustion so they can get to a gas station. They can't jump start a Tesla. Can you see them with the battery trying to, oh no. I think that was funny, actually. All right, so if, like I said, if you have one of those, more power to you. I live in West Knoxville. You see more EVs in West Knoxville than you do almost any vehicle except Mercedes. And people think that they're saving the planet. Well, that's perfectly fine too. But if you want an example of harmful federal government intervention into markets, and this into the energy markets and the byproducts from it, if you are unbiased, right? I mean, there are some people who treat climate change as a religion. I look at climate change as fall, winter, and spring, and summer, but that's me. But regardless of where you are on that spectrum, it is hard to come out with any conclusion other than government intervention into the energy market has made us all worse off. Now you say, well, we may be poorer, but we're breathing better air. That's debatable. Go out and measure it and see if we really are, because it turns out we're really not. But it doesn't matter. It makes you feel good, but the problem is it's making you feel good at my expense. So that, to me, is a more current example of government interference into the marketplace, skewing prices and hurting consumers. Now, ask yourself this. Who are the consumers that are hurt the most? It's the poorest of us. It's the folks who are the lowest income. It's the people who go borrow this money to pay their utility bills that have doubled, tripled, and quadrupled. You cut off the access to them getting that short-term credit, they can't even pay their utility bills. But you've made them better off because they're breathing cleaner air. That's my soapbox. But the only thing that I say is that this whole area, whether it's financial markets, financial institutions, environment, they're all ripe for researchers who have not an agenda, who have an open mind, who will understand the underlying industry that they're studying and writing on. Bob Schweitzer was on the board of one of the largest banks in Delaware. I'm on this huge board. And Bob and I are reading the director literature, and Bob said, academics don't have a clue as to what's going on in the boardroom. Why don't we write a paper? So we wrote a paper on academic directors. Bob unfortunately died while we were writing the paper. I brought on board one of my doctoral students, Josh White, who's now at Vanderbilt, and Tracy Wuttke, who is now the department head. And Tracy is an expert in corporate directorships from an academic standpoint. And we were able to produce this paper. It's in the Journal of Corporate Finance, and it turned out to be the most cited article in that publication. One thing that I'm proud of, and I'm really proud of this, is that last week, from one of the citation reporting sites, and remember, I've been retired for 11 years, they sent me a note saying that within the past 6 months, my work has been cited 583 times, and I'm in the top 20% of all citations. I think, and even my credit union papers are getting cited, because Bob and I did the first real analysis of credit unions. And I think simply all of this has occurred because I've taken a different tact, if you will, than most academics. Now, I will caution you one thing. It is risky from a professional standpoint to do what I've done. Because I wasn't going back to the University of Florida. I had a great job at the control of the currency. I was making more money than I made as an academic. And so when they said, we're going to deny you tenure, I said, up yours. I didn't care. There was no risk involved with me on doing that. But let us suppose that I didn't have that fallback position. You know what I would have done? I'd have written these dry pieces on monetary processes. I would have gotten tenured and promoted, and then I would have done the discrimination stuff. One other thing, the biggest leap I think I made in my career was one of the most unsuccessful ones. Several years before I retired, I went to the then department head and I told him, I'm going to be a good faculty member, but I'm going to do a type of research that probably won't generate anything for a while. So, you're not going to see me producing papers for a while. Because I got with one of my colleagues who was an industrial psychologist to do one thing. I wanted to know if all of the diversity training mandated by the federal government and by our universities were effective, if they made a difference. I had some discussions with some of the people in this room about that, who are resentful. And CRT does this today. CRT says if you're white, you're a racist. Now you say, I'm not a racist. There's not a racist bone in my body. CRT says every damn one of those bones is racist, whether you know it or not, because you have a leg up on people of color just because of your skin. Tell you what, you go to Appalachia and tell those people that. So I got with an industrial psychologist who had a contract with the U.S. Army to test new recruits, because the Army does not want to assign a pacifist to an infantry platoon. And I'm getting ready to finish. I'm sorry about this. Turn me loose, and this is what happened. So look, he had this successful contract, and I said, can you do a measurement of Gary Becker's taste for discrimination? He said, sure. So he and I worked together to do a survey to test for discrimination, and we gave them to our students. He's white. So he tested his students, I tested my students at the beginning of the semester. At the end of the semester, we tested them to see if their attitudes toward race had changed. His students' attitudes didn't change one bit. My students' attitudes changed toward one person. Right? Didn't change toward black folks, didn't change toward anybody else, but changed because of me. I mean, they had interaction with me all, and most of them thought I was an SOB anyway because of my grading. I took off points from misspellings. I gave them a list of words that you couldn't misspell in finance. I said, if you misspell any of these, I gave it to them. You misspell any of these 5 words, I'll take off a point. I had a student who said, I would have made a B in your class if you hadn't taken off those misspellings. I said, well, you were obviously a C student, so why come complain? All right, so look. So we had this instrument, and what we wanted to do was to go give it to my bank clients for them to give to their loan officers. And we were giving them this because we were going to use the data, right, and publish papers with it. But then if it was really successful, maybe we would sell it as a product. Guess what? Every single lender rejected it. They did not want to know if the training were effective. They just wanted to check the box. They didn't care. Government says, train these people in diversity. Yes, sir. Train them. Was it effective? Look, if it weren't effective, then they would have been chastised and sued for putting those biased loan officers back to making loans. Where's the future lie? Find out if there's a difference in discrimination face-to-face or on the internet. Look and see if there are similar clienteles and if the results are different, and try to figure out why. All right? I mean, face-to-face, you know what the person looks like. Internet, you don't know. Even if these things are being reported, you may know from geocoding some of the stuff done out there. If they don't know race, they use the percentage racial makeup of a census tract to assign a probability of race to that other person. You've seen that sort of work. But go do that. That would be, I think, interesting. But also, once again, never lose track of the structure and characteristics of what you're studying, because if you take those into account, your papers will have a lot more impact than someone who just takes the old traditional ivory tower approach. Thanks very much.